Welcome everyone, and thank you for joining Treasury Strategies webinar regarding new challenges in card optimization. I'm Paul LaRock. I'm a principal with Treasury Strategies, and joining me today is Steve Wiley, also a principal with Treasury Strategies. A quick aside, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording. Should you wish to ask questions, you can do so in the question box in the bottom right-hand corner of your screen. We'll handle those questions offline primarily. We have nearly 900 people registered for this webinar, and so with that in mind, we wouldn't be able to answer all the questions within the context of the webinar, but we'll try to do our best. So we'll take a few and try to answer them during the webinar, and a few more might be answered then afterwards. We'll just send emails or something to you. So today's webinar is going to be a unique look at the card environment. Frequently when people talk about and work with cards, they'll work with the incoming cards, the merchant card processing side, kind of in a silo, and then the disbursement cards or purchasing cards in another silo. That's the disbursement side. What we're going to attempt to do on today's webinar is to talk about the whole spectrum of cards, incoming transactions, outgoing transactions, and the unique and important element of security that's inherent in both. So when we think about the card processing environment, there's three things in common across the card spectrum that are drivers for usage. One is the inherent efficiency and manageability of cards. The second is the possibility of reduced processing costs. And the third is controls. Controls, particularly in regards to PCI security, have become a top-of-mind issue across the retail space and across associated areas like higher education, healthcare, etc. We'll talk a little bit later. Steve will go into detail about PCI compliance and data security. As all of you know, there have been a number of prominent security breaches regarding card systems, and it's making the newspapers and TV shows, and is causing tremendous reputational risk to those who are victims of that, as well as a financial risk for those who actually have their cards stolen or the companies who are responsible for those thefts. And so when we think about the processing environment, when we talk about card receipts, we're talking about the collection side, the accounts receivable side of your business. And card receipts come in through a number of payment channels. They can come in through point-of-service terminals. You can have online transactions through a website. Card transactions come in through lockboxes. So when people are given the option to pay by a check or credit card, they will send the written-out credit card transaction as their payment to a lockbox. And then you have to handle the movement of that data from a lockbox into some processing environment. Another way they can come in is through a voice response system, call-ins to pay bills, a common protocol for utility companies. On the disbursement side, that is the card payment side, we find P cards, accounts payable ghost cards being used, T&E cards. There's a lot of others too. There's fuel cards and fleet cards that could also be used, but they're all cards used for disbursements. There's a couple things they all have in common. One is card data. It is critical to maintain the security around it. The departments who supervise or are responsible for the programs as well as the data could be a Treasury department, an accounts receivable department, an accounts payable department, an IT department, or we could wrap it all together into a shared services function. Some shared services functions at some companies involve all of those different disciplines. And across cards, by definition, is the technology aspect. And so you have the technology associated with incoming card transactions as well as the technology associated with outgoing transactions in terms of tracking the payments, controlling what cards can be used for, what they can't be used for. And all of this is wrapped in a security and regulatory environment associated with the critical nature of individual card data and the important element of security surrounding the fact that we can never lose that. We can never let anybody break into our systems, break into our file cabinets, and get at that. And so as we look at corporates, we see a number of common challenges that we frequently see across industries, across clients. One is that merchant card processing is frequently decentralized. You can have multiple departments overseeing the activity, And when I say multiple departments overseeing activity, I'm not talking about a multidisciplinary team working together in coordination with one another. That would actually be a good thing, but rather multiple departments that are disjointed from one another. They may not even know what programs each other are managing. This lack of centralized authority then could lead to lack of visibility over the various payment channels as well as the different merchant card processors that are involved in that. We frequently see a suboptimal structure of card processing that involves multiple card processing relationships. This unnecessary complexity leads to very complex pricing environments. In one part of your company, you can have wrapped pricing, which is just a single interest rate being charged on all your card transactions. That usually is not something that is beneficial to the card client. Alternately, another one could have pass-through pricing where it's interchange plus a certain fee, but those fees can vary between the merchant card processors. You would have different merchant card processing systems and reporting mechanisms in place to track it. And all of this can lead to an expensive structure. We have multiple pricing tables being used, wrap pricing, and an inability to leverage the scale. Cards, whether they're incoming or outgoing, whether we're talking about merchant card processing or whether we're talking about a purchasing card, there's an economy of scale in giving a maximum amount of volume to a single vendor. That's how you maximize or minimize the interchange costs and the fees on the incoming transactions. And when we talk about disbursement cards or payment cards later on, that's how you minimize your costs and maximize your rebate through some economy of scale pricing. Complexity and a lot of moving parts almost inherently leads to weak security. You've got a combination of complex systems, a lack of visibility. With so many moving parts, you can leave parts of a system open, subject to security breaches, and thus lead to PCI noncompliance. So to the extent one can streamline merchant card processing, document and have good visibility over it, you're moving towards an environment in which you can have an advantage in terms of incorporating security best practices. So let's do an audience poll. How would you describe the state of merchant card processing at your organization? Would you think of it as being optimal, satisfactory, suboptimal, or perhaps don't know because it is a very complex environment? We'll wait about 15 seconds and permit attendees to answer the question, and then we'll share the poll results with you. Okay, we'll bring up the results now from the polling questions regarding how you view the state of merchant card processing within your organization. Okay, so as we look at this, we can see that 5% feel that they've optimized their structure, 22% of respondents are satisfied, 17% are not satisfied, and some 11% don't know. And I assume the ones who don't know, it's largely a result of complexity of systems. Okay. So, what are things you can do about managing or optimizing your card program? And one of the things you can do is an assessment of merchant card processing. One of the things you want to ask yourself is card processing activity centrally managed? We're not saying that the actual processing has to be centrally managed. That is usually impractical to do. But the oversight and responsibility for that processing should be centrally managed. Then you want to ask yourself, are card payment channels documented? So one of the first things you think about is, how do card transactions come into our organization? Do we have a lockbox? If we have a lockbox, are card transactions being submitted through there? Are people filling out remittance coupons and writing card numbers and expecting us to process them? Do we have a website? Do we have 2 websites? And how are card transactions coming in that way? Are we taking cards over the phone? And do we have point of sale? So obviously if you're a retailer, you're going to have a lot of point of sale transactions. And so you need to document the various channels by which cards come in. Then you want to ask yourself, is anybody monitoring fees? So if we look at certain industries, think about retail, restaurants, travel, entertainment, I can tell you with near 100% confidence any major player in those industrial segments is carefully monitoring fees. They've been doing it for decades. But as you go out of the traditional industries of used cards, when we think about healthcare, when we think about higher education, when we think about industrial distribution businesses, all of those companies in those industries are seeing upward trends in card activity, and they are not used to and perhaps don't have the skill sets internally to monitor the fees. And sometimes they're blindsided by the dramatic increase year over year in card fees as more and more of their customers use credit cards. Then you want to ask yourself, is the process optimized to maximize efficiency? So efficiency isn't just about fees. Efficiency is about the ease and burden of accounting. Is it being done efficiently? Do you have stated policies to promote efficiency in terms of processing refunds, handling chargebacks? And so you have to look at all the different work elements in a merchant card processing relationship. And then is the process optimized to minimize risk? So we're not just talking about PCI compliance in terms of risk, but we can talk about internal fraud. So there's something called refund fraud. It's when one of your own employees executes a refund, except the problem is they just did the refund onto their own card. So when you think about merchant card processing, we think about it as a mechanism by which money comes into your company. And one of the most dangerous things that a company can do is fail to realize that something they perceive as an incoming conduit for money can in fact be reversed. When you think about a refund, it's money moving out, right? The money goes out of the bank account and goes somewhere else, goes to an employee's card, goes to a customer's card. And so you have to be as attentive about merchant card processing, the fraud associated with it in terms of outgoing transactions, as you inherently would be on an accounts payable process. And finally, and this is the big media event right now, is are you PCI compliant? That has always been important. It's important enough that Steve Wiley will be devoting an entire segment of this webinar to that topic. So the call to action around merchant card processing improvements is to recognize that there's about about 5 keys to success. The first is centralization. Centralization permits you to have scalable processing procedures, which are aligned with best practices. It allows you to have stronger oversight over processing activity. The next is to optimize the structure by reducing the number of merchant card processors, streamlining whenever possible. You can get improved pricing. You can get efficient accounting and administration. You're working with fewer systems, so you can interface fewer systems more easily than you can a large number of systems. You will have an improved control framework. And then you have to think about pricing. Reduced processing fees can be achieved by doing a merchant card processing RFP. And Steve, we've done some work in this area.
Yeah, Paul, we recently helped one of our larger corporate clients with an RFP for merchant card processing services. Within that RFP process, they were able to renegotiate pricing. Their current pricing was extremely high, and that's something we frequently see with well, I guess ad corporates who have not RFP'd the business in a long time. And so really by completing the RFP, they achieved a little over $1 million annually in savings. So it was a good process to go through with them.
Yeah. So one of the things that can come out of an assessment of your merchant card processing procedures and volumes is you'll empower yourself to have the data to go to market to do an RFP. So if you don't know how many merchant card processors you have, if you don't know how many transactions you have by card type, it's kind of hard to articulate a intelligent RFP for merchant card services, because any of the vendors providing that service are going to need to know about your volumes, about your structure, what your needs are. The next thing that's a key to success is strong controls. And so we're going to talk about PCI compliance, but we also want to be aware that there can be problems with cards that are not associated with PCI compliance. It can be used to launder money. Cards can be used to commit refund fraud, which is what I talked about earlier. So you want to have a body of strong controls around the card transactions. And then finally, you have to decide where is the expertise to do all this. Do we have it internally? If we don't have it internally, are we going to go outside to get some expertise to assess our program, maybe to run an RFP? And that each company has their own answer to that. The closer you are to the traditional industries that have used card, again, restaurants, hotels, travel, the more likely it is you have the expertise internally, and you have a department that works on that. As you move away from that, as you start getting into higher ed, into healthcare, into government, for example, the less likely it is that your organization is going to have the expertise in-house. And so you just have to make a decision about how you want to approach that part of it. So the key considerations when thinking big picture about cards is to recognize that cards are a subcomponent of a collection strategy. So by a collection strategy, I'm not talking about like what your credit term should be or something like that. We're talking about what payment vehicles do you prefer your customers to use when they pay you? Check, ACH, card, wires. And for each company in each industry, there could be a slightly different answer. And so once you do a hierarchy of preferences about payments coming in, then you can articulate to the clients and do certain things that would incentivize people to pay the way you want to be paid. The next consideration, of course, is security, and that's around PCI, that's around fraud. The next thing you want to consider is that in October of 2015, retailers are going to be required to have devices in place to handle chip cards. So they're formerly known as EMV cards. That stands for EuroPay, MasterCard, Visa. These are the cards that are used all over, pretty much everywhere outside the U.S. These are the cards that have been deployed. In the U.S., we have exclusively MagStripe cards. Those are being replaced by some banks in some markets with chip cards, but there is enormous pressure by the card companies like Visa and MasterCard for the banks to swap out the magnetic stripe cards with the more secure chip cards. You also want to consider enhanced products like Visa's V.me, Google Wallet. Visa's V.me is one of the newer products. It supports enhanced security as well as faster checkout for online transactions. Interesting thing about that particular product is it's offered free to the merchants and can be used for non-Visa cards like American Express, MasterCard. And then you want to think, where is the internal, or are we going to get external expertise? Okay, with that, I'll turn it over to Steve to talk about merchant card security.
Thanks very much, Paul. As Paul mentioned, the subject of card processing security has grown very quickly into the elephant in the room for everyone, really everyone in the card industry. The industry's been rattled to its core by some of these widely publicized security breaches. We have some of these companies that have been affected listed within the table on this slide here. But lately it seems like every other week we're hearing about a new company that has had a major security breach or data breach. Just saw University of Indiana was in the news yesterday. Big data breach. That was not a card data breach. I had a colleague actually email me an article from Reuters. The headline was, FBI warns retailers to expect more credit card breaches. So it's something that's just been, it seems like every week we're reading about kind of a new company that has been targeted. So because of these recent breaches, card security has become a top concern for corporates. And we're seeing this firsthand at many of our own clients and corporates we visit. We're seeing initiatives related to reviewing and improving card processing security being accelerated or pushed ahead of many other projects as a result of this new strong sense of urgency that has been created from these other breaches. Corporates don't want to be the next security breach headline in the news, so they're taking steps now to ensure that the risk of a breach is minimized. Many of the initiatives we're seeing at corporates have to do with ensuring PCI compliance. PCI is a set of card industry security standards for organizations that process cardholder data, so it's a natural starting point for organizations when they're assessing card processing security, just to review their state of PCI compliance or to become PCI compliant, for the first time. So we've been helping many of our corporate clients with these PCI compliance projects, and obviously we had a lot kind of popping up because it's on the radar screen right now. And there have been some interesting observations as we visit corporates. It's surprising how many corporates that process cards have not confirmed PCI compliance or simply haven't been diligent in ensuring they remain compliant. In many of our clients, we're having to start these compliance projects really from the ground up by collecting data, just to learn where and by what channels they're processing cards. And, that observation's a little scary. I think it'd probably be more characteristic of those companies that have that decentralized merchant card processing structure that Paul alluded to earlier in the presentation. On this slide, we've just framed out the 12 PCI compliance standards in order to help familiarize the audience with all the areas of compliance. I'm not going to go through each of these in detail, but I would just note that there are a number of different substandards within each of these standards that must be met to ensure compliance. And here we've just noted for you where you can access these on the PCI Compliance website. There's a number of great resources on that website. There's one important consideration about PCI compliance we want to talk about on this call, and that is the fact that those companies that were listed a couple slides earlier that were breached, those companies, many of those companies were PCI compliant, yet they were still breached. And that poses an important question. How valuable is PCI compliance if I can be compliant and still get breached? Is the problem with PCI compliance standards themselves, or is it with the implementation of the standards, or is it something else? Well, many think the compliance standards themselves are not adequate. For example, PCI does not mandate checking for malware, but none of the most popular anti-malware products could identify malware from the most recent retail breaches. And PCI doesn't mandate next-generation anti-malware security that's starting to emerge. Another example is around encrypting data. Currently, PCI standards only require encryption for data at rest, but not while the data is in transit along the transaction chain. Now, the PCI Council recommends that retailers and others in the payment industry adopt a more comprehensive point-to-point encryption approach, but it's not a requirement yet. Others will argue that PCI compliance standards are adequate. However, the enforcement of the rules has been weak. For example, many believe that the annual assessments and quarterly scans of firewalls that take place should occur more frequently or more thoroughly. So really, while these are relevant concerns as to what are kind of causing the breaches, here is what we want corporates kind of to be aware of as they review their card security program. While PCI compliance is no guarantee against a data breach, corporates must adopt the standards in order to reduce the risk of a security breach. And we just want to pause here for a moment to poll the audience. The question is, are you confident in your current level of merchant card processing security? So if you could take a moment to answer this question, we'll then discuss the results. While we're waiting for people to answer that question, just a reminder, you can submit questions, and we'll get to as many of those as we can at the conclusion of our presentation today. Okay, we've got some responses coming in. We'll give them a few more seconds here. Okay. So we just had the responses come in. It's interesting. 20% answered they were confident in the current level of processing security. 12% are pretty confident they're, or I guess not confident in their current level of merchant card processing security. And then the don't know is also 20%, and we had about half of you did not answer, and that's okay. I think looking at these numbers, they really illustrate the need for many of you corporates out there to review and improve card processing security measures, so that yes number gets a little bit higher. And on that note, we think there are 4 broad steps corporates should take to improve card processing security. 1, you need to gather those key stakeholders responsible for merchant card processing activities and educate staff on PCI compliance and cardholder security. PCI compliance, it's not just about processes and technology, it's also about people. Making sure people in key merchant card processing roles understand the standards will help you learn when and where you have gaps. Secondly, evaluating your merchant card processing environment. This involves analyzing all physical and electronic points where the organization is receiving card payments and learning where you have gaps in PCI. Number 3 there is really remediation. After you've learned where your gaps in PCI compliance are, take the steps to remediate. And then lastly, maintain defenses. Remember, PCI compliance is only received for one point in time, so the more frequently you can test and validate PCI compliance, the less likely you'll be prone to security breaches. And on a final point before I hand it back to Paul here, really seek external help where you need it. It's very common for us to see corporates we visit who either they don't have the staff capacity or the expertise to complete an in-depth merchant card processing review. We could certainly help you with that here at Treasury Strategies by leading literally all 4 of these steps, and there are plenty of other companies that could help you as well. So, I think I'll pass it back over to Paul now, who's going to wrap it up by talking about the card payment portion of the presentation.
Thank you, Steve. And so when we think about the challenges in corporate card payments, we're thinking about the outgoing transactions. So the first part of our webinar, we were talking about merchant card processing, incoming cash using cards. Then we talked about the common denominator of data security. And now we're talking about the other side of the house, the payables or disbursement side of the house. And as with merchant card processing, we find the common challenge of decentralized management over card programs. Cards from multiple issuers are used. There's a lack of centralized authority and an inability to leverage scale to receive better terms. And so what is very common is for the operating units of a large company on their own to set up card programs for their employees, for their accounts payable departments. And so a large company may have 3 or 4 different card programs. Because the transaction volume is spread around and broken up into several different pieces, they never hit the levels at which the rebates on the card programs are triggered. That complexity then leads to a lack of proper controls over the cards. So one of the nice things, a well-run P-card program is a first step towards better internal controls. And the reason for that is, unlike petty cash, unlike checks, is a credit card is sort of a mini little computer device. You can control it real time. You can raise and lower the maximum amount a person can spend. You can change the industrial service codes which the card can be utilized, the different types of stores. At a minimum next-day basis, sometimes real-time basis, you can see the actual transactions that are going through. No other payment vehicle has those characteristics, and so no other payment vehicle lends itself to such close technological control over spend. The next challenge that corporations face is a lack of controls around cards. If they're small card programs, they frequently don't have written policies or procedures for proper card usage. If they rate the policy, then they don't distribute it to the employees, so the employees are kind of not fully informed of what they should be doing. There is frequently not an interface between a card system and an accounting system. So a lot of the benefits of automation associated with the card transactions are lost because you don't have a system interface. The worst case scenario is a card program is started by a company. Everyone's very excited about the benefits of it, but then they shortchange it by not hiring adequate staff to manage it. So that's kind of like buying a Formula One racing car and then asking some overworked staff accountant in the corner cube to run it for them. It's just going to end badly. So if you can't afford to implement a card program properly in terms of bringing the technology and human resources to bear over the program, you probably shouldn't do it at all. The leverage, technological leverage of a card program will work against you rather than for you. The next thing we see is limited usage of cards. So the card payments are not encouraged with the vendors. This is because there is a lack of sustained focus to increase spend. So the first few months, there's a lot of effort to call vendors, get the cards accepted with those vendors, but then it kind of peters out. And so years later, people are disappointed in their card programs. They had never met expectations because in frequently understaffed corporations, you have different priorities that are changing, and the project teams are diverted to other projects, and they never finish the card implementation project. And so cards are still not leveraged as preferred payment vehicles at many corporations. So one of the first steps is, if you have a card program in place, is to assess the program, or I should probably say plural, the programs that you're running. Sometimes companies have a P card program. With another bank, they have a T&E card program. With still another bank, they'll have a fleet card program. And so you want to ask, is card processing centrally managed, or do we have procurement doing one card program, an operating unit doing another? So again, I'm not saying that everything has to be processed centrally. It's got to be managed and overseen centrally. You want to ask yourself, are policies in place to manage card usage, and do the employees see those policies? Some of the clients we have who are implementing best practices and card program management require the employees to sign an agreement regarding the acknowledgement they've read the policy and are going to comply with it. Then you want to ask yourself, are there policies in place to prevent fraud? And so because this is a disbursement vehicle, everybody's radar screen is pretty sensitive to this, is you don't want employees or anyone in the company using the cards in such a way that's not authorized. They can't run their personal expenses through it. And then which vendors accept card payments? And so when you think about your whole pool of vendors, you want to think about cards, like merchant card processing, as part of an overall payment vehicle disbursement strategy. How do you want to pay your vendors? You've got a finite set of choices like every other company. You got ACH, wires, checks, cash, cards. Do you prefer cards over the ACH? Which vendors are you going to pay which ways? And then when you think about that, then you want to think strategically, what proportion of total AP could be on card? For most companies, that number bounces around 10%, 12%, and so how close are you to getting that volume of transactions moving through cards? And then, just as importantly, what will you do to automate accounting for the card transactions? One of the things that legitimately would slow down a card implementation is you have a lot of vendors willing to accept it, but the back-end accounting is all manual. And we've seen cases where card program implementations have had to be paused as programming is done on the back end to interface the card system with the ERP system of the client so that they can relieve their payables in an automated way rather than doing manual posting. And so the call to action around cards includes three essential elements: the centralization of management over card programs, so you have a scalable processing procedures, consolidate the volume with your primary provider or providers in order to reduce the price and increase the rebate. Cards are an interesting thing because, we use the word price, but really purchasing cards are one of the few negatively priced banking products in that you usually don't pay them, they pay you. And so the way the game is played is different than merchant card processing. Merchant card processing, what you're trying to do is reduce the fees you pay the card companies, the processors, right? With P cards, you're doing the opposite. You're trying to maximize the amount of money they pay you. And then centralization permits policy enforcement across all the card programs or all the employees. The next key to success is the use of appropriate technology. We very carefully inserted the word appropriate there. So the bigger the company, the bigger the card program, the more you're going to need technology, some of which you're going to have to pay for. Other technology will be provided to you by the card issuing bank. And so you need to make some judgments about what the role of technology is in your program so that it leads to improved controls and visibility of the transaction volume. You want to automate the accounting for card transactions, and you want to expand the usage of it, which is the third key to success. You want to maximize your rebate. You want to streamline and develop a cheaper form of payment processing. Purchasing cards are a cheaper way to pay vendors because you don't have the check processing cost, they're not like a wire, and then they also have the benefit of helping your working capital, right? Because when you put a transaction on a card, you don't have to pay the money out right away. You can wait up to 20, 25 days depending on what you've negotiated with the card issuer, and so you can get a nice benefit to working capital through the use of a card program. Issuing an RFP for corporate card services is a great way to expand a program that's in place and build momentum for expanded usage.
Right. As we discussed with the merchant card processing RFPs, it's a great way to save a little money. We're always working with our clients on purchasing card RFPs. We recently helped a large corporate client with an initiative to integrate the corporate purchasing card and T&E card into a unified program, which really helped them ramp up volume and just get better overall control over each of those programs.
Mm-hmm. We also had an interesting project where a company's fuel card was integrated with their fuel hedging program. So one of the challenges to any hedging program is you don't want to overhedge or underhedge, right? And so one of the nice things about a card is you have near real-time data on the transactions. And so for that client, rather than wait on a 1-month lag to get all their fuel spend, their actual fuel spend, and compare that to the forecast of fuel spend that was the basis for their fuel hedging program, they were able to look every day on a 1-day lag. What are we actually paying, say, this June on our fleet vehicle fuel expense relative to last June, and how do we adjust our contracts for purchases of fuel so it aligns with the actual volume. That was kind of a cool use of card. So card is you have to think generically and holistically about card. A card is a data tool, and you can do so much more with it other than just buy something because it has the data embedded in it. So there's a lot of exciting possibilities to card that continue to be explored by many companies. So the key considerations when you think about your commercial cards, your purchasing cards, is to remember that like merchant card processing, cards are a subcomponent of a payment strategy. So you want to think strategically about the various ways you get paid and how do the various ways you pay and how do cards fit into that payment strategy. And then you need to develop that strategy, always maintaining an emphasis on security. So here we're on the other side of the security wall, right? This is your card data. And so you want to be very careful about who you give the card numbers to and when. Companies who are frequently using purchasing cards oftentimes use single-use card numbers so that the card number is used for a single transaction by a single vendor. It is broken down or contained by a fixed dollar amount or slightly variable dollar amount. So if you authorize the charge to a card for $5,000, the vendor can't turn around and turn it to $15,000. The card would decline. They wouldn't get the authorization. They couldn't push it through. So again, cards have all of these IT possibilities for enhanced controls that a check or something else wouldn't have. And then you need to develop an implementation plan to turn the concept into reality. So let's do another audience poll. How would you describe the current state of your corporate card program? Would you describe it as optimal, satisfactory, suboptimal? And you can vote now. We'll wait about 15 seconds, 20 seconds to get the poll results. And after we get our poll results, we're going to talk about 3 key takeaways in each of the 3 subject areas of our webinar regarding merchant card processing, data security, and payment cards. Okay. So about 10% of our respondents are comfortable with the optimization of their program. About 13% think it's suboptimal. About 9% don't know. Okay, well, thank you for responding to that. So the key takeaways around our 3 subject areas. First, around merchant card processing. We would encourage you to rationalize your merchant card processing relationships in order to reduce fees and improve controls. You can consider an assessment or an RFP for merchant card processing services. If you don't have the data, if you don't know a lot about your various programs, the assessment obviously has to come first. around merchant card processing security, especially around PCI compliance, you need to take action to ensure your company has the right level of merchant card processing security and is PCI compliant. So sometimes there's a little bit of confusion around the topic here, and let me just touch on this for a moment. Everybody who processes card transactions, if you do one transaction a year, you must be PCI compliant. Those who do higher volumes have to actually validate that. And the PCI website that Steve spoke about earlier shows you those different validation levels. So if you're a relatively low volume processor, then you don't have to validate, but you still have to comply. So the rules are the rules. And then around corporate card payments, you can expand your program through consolidation and centralization of that program with a single vendor. So you get as many transactions moving through one card issuing bank as possible, thus increasing the possibility for a rebate and thus increasing your capabilities of controlling and understanding the card program that's under management. Now we'll take a few minutes to permit you to ask questions. So we have a couple questions coming in.
So we're going to just give us one sec while we get a few of those questions up here. So you can scroll down here and take a look at these.
Okay. So we have a question about how the slides can be downloaded. You won't have to download them. All registered attendees, we're going to send you the deck, so you'll have everything. Then moving on, next question.
Paul, we have a number of questions around, besides merchant card processing RFPs, what can organizations do to reduce the expense of accepting cards? Can B2Bs decide who they accept credit card payments from, e.g. only those customers not on terms or transactions less than 1K? Those two questions are tied pretty closely. What we're seeing at corporates are preferred forms of payments defined within a collections policy. So when a new B2B relationship is set up, the preferred forms of payment will be or should be defined in that collection policy. Now, there's also another question down here. We've seen organizations.
Let me jump in. One other thing they can do. So when you have a contract with a vendor or supplier or a customer, you can define the payment terms in the contract. This is a growing issue in healthcare, where some third-party administrators, some insurance companies have begun to pay hospitals and physicians with cards. And so these are large dollar transactions. So envision a $100,000 ACH coming into a hospital to pay for insured coverage. If an ACH was at less than $1 to process, right? Maybe less than a quarter. That same underwriter pays that hospital with a card. They could easily have $2,000 to $3,000 in processing costs. And so what hospitals have begun to do is define in their agreements with the payers how they will be paid. They will say, you will pay us with an ACH. You can define it that way. On the merchant card processing side, other than an RFP, what you can do to reduce the expense of accepting cards is to bifurcate the fees you get between interchange, which you cannot directly control, and the fees that the merchant card processor is charging you. And so about 80 to 90% of the fees for cards is going to be interchange. And the way you can lower interchange, the interchange that's charged to you, is largely a game of speed and data. So the card issuers lower your fees if you get them the transaction fast and with a lot of data. And so when you think about that, if you can settle every day and send your card transactions near real time or at least close out every day, so there's as much data about the card transaction as you can, level 2, level 3 data, what have you, you'll have a lower interchange rate. The other thing is you want to think about what industry you're in. There are certain industries that have preferred interchange rates. Insurance, for example. Insurance premiums are processed and the interchange applied to them is lower than in other industries. So that's sometimes called the emerging markets rates. So you have to look at interchange rates, think about your industry, and figure out with your merchant card processor, what are the lowest rates we can get on each type of card. So for a MasterCard, card not present transactions, what's the lowest rate we could be eligible for? And think about what you can do in your systems to process those cards in that way. So it's a very tedious step-by-step process. It takes a long time to optimize it, but here's the nice thing, is the benefit is recurring in nature. It recurs year after year. So though it may take a lot of time, once you get it optimized, it will stay optimized for some time and help you get lower rates. We're just reading through questions. Stay with a second.
I'll take one
Okay.
real quick, Paul. We have a question. Are companies taking a larger number of transactions required to proactively submit PCI compliance certification to their merchant banks, and if so, how often? So all merchants will fall into one of the 4 merchant levels based on your card industry provider, like Visa transaction volume over a 12-month period. So the answer to that question is it depends on your transaction volume. There's generally around 4 levels. For example, Visa has 4 levels. So level 1 is, any merchant processing over 6 million Visa transactions per year. You're going to have different compliance requirements than a merchant processing fewer than 20,000 Visa e-commerce transactions per year. That would be level 4, and then there are levels 2 and 3 in there. Level 2 is any merchant, regardless of acceptance channel processing 1 to 6 million Visa, and 3 is 20,000 to 1 million e-commerce transactions per year. So I'd point you towards that PCI compliance website within this deck. They'll be able to actually, on their website, they'll map out for you the specific compliance requirements within each of those transaction processing levels. So first determine which transaction processing level you're at, and then go to the website and kind of learn what your specific compliance requirements are.
Okay. We have a question, if we have seen organizations choose to no longer accept credit card as a form of payment from customers due to the expense and compliance issues, and has there been a loss of customers as a result of this? I have not seen any of our clients nor any companies I know of do that. I have seen multiple times companies think about doing that and choose not to because they're afraid of the hit to revenue that might result from that. What I've also seen is companies refuse to accept cash and take only checks and credit cards. So if somebody is accepting payments, unless they're a very small retailer, standalone shop, they're almost always going to accept cards if they're dealing with consumers. B2B gets a little bit more complicated. You'll see quite a few businesses that will not accept credit cards as payment. And we have a question, are companies taking large numbers of transactions required to proactively submit PCI compliance certification to their merchant banks? So by proactively, it's not really a proactive or passive approach. As if you have a certain amount of e-transactions, if you have a certain amount of transactions overall, you'll be classified as a level 4, level 3 processor. Your merchant card processor is supposed to be monitoring the volume of transactions each year. And they would tell you that you have to submit or validate. So I think by when you're using the word proactively, it might be what I would call to validate your compliance. And we have a comment on large value interchange announcements by MasterCard and Visa. So MasterCard and Visa, in order to encourage corporates to use cards for purchases and transactions between each other, permit a much lower interchange rate to be applied to large ticket items. And so frequently the way that works is the interchange percentage all but disappears, and you get a per transaction charge of $10, $20, $30, something like that. Both MasterCard and Visa on their websites have their interchange tables, and they talk about what it is that you have to do to qualify for those rates. The next question is, what are the minimum requirements for monitoring a card program? So if we're talking about the merchant card side of it, the minimum requirements are to each month to know the total percentage of your sales that are coming in through card and to watch that over time. So you have a 12-month graph. If you're in certain industries, you're going to have a upward sloping line as more and more of your customers use card to pay you. The second thing you should do is to monitor fees by dividing fees by card revenue, not total revenue, but card transactions. And that will indicate to you if the cost of your card program is increasing without you understanding why. If you see it rising, then you have to investigate. And so those two things, in terms of monitoring the program on the merchant card side, are critical. The third minimum requirement is to have your merchant card processor provide you with a credit without debit report. And what they do is they store all your charges for several months. And what they're looking for is refunds in which they don't see an originating transaction. That's how you catch people committing refund fraud. So if I'm your employee and I issue a refund to my card for $300, there better be an original card transaction. And if I'm stealing money from you, it's not going to be there, and so you'll get this credit without debit transaction listed on that report. You're going to get a lot of false positives because of what's going to happen is really old transactions that you're doing refunds on will fall outside of the time frame window the systems are monitoring. But buried within that will be legitimate fraud transactions that you have to investigate and deal with. On the disbursement side, on the payable side, you should know what your spend is each month. You should monitor for lost cards, stolen cards, and keep track of that. So you're looking, that's kind of a strong internal control mechanism. But kind of at the highest level, the strategic level, is if you have a goal that 5% of your spend is going to go out through cards, then each month you should be charting your progress to that goal. Okay.
All right. Well, I think we want to wrap it up just a little before the top of the hour to give people 5 minutes to get to their next meeting. We want to thank everyone for joining and submitting all these great questions. Go back a slide. Just want if you're in a position where you need help reviewing or assessing your card program, or with any of the kind of the things we've mentioned, obviously in this webinar, please reach out to Paul and I. And if you have any other questions in general that we didn't get to, go ahead and email us, and we'll be happy to either email you back or set up a meeting.
Okay. Thank you very much.
Thank you again.
Everybody have a great afternoon.